Hey guys, it's Henry. The market has been falling, yet prices for everyday goods and especially houses have been increasing. The median house price is as high as it's ever been. They're also expected to rise another 11% this year. If you look at the year-over-year CoreLogic Case-Shiller Home Price Index, it's very hot and currently growing faster than pre-2008 levels. So in this video, we're going to talk about diversifying your money to protect yourself against a real estate bubble that can impact the stock market to 2008 again. If you appreciate my research, it would help me out a lot if you hit that like button for the YouTube algorithm. That's all I ask. The first way to protect yourself in case of a crash is to dollar cost average. Dollar cost averaging is an investment strategy in which an investor contributes the same amount of money into their portfolio on a regular basis, like $300 to $500 a month. Regardless where the market is, you're going to buy high and low, but on average, make more money than someone trying to time and predict the market. In fact, if you were to buy perfectly every dip in the market for over 20 years versus put $100 to work consistently, here is how your performance would look like. In fact, buying the dip has not outperformed dollar cost averaging since the 1940s. The next way you can protect yourself is by buying alternative assets. During the record high period of inflation, alternative assets have become, as JP Morgan said, no longer optional. While alternatives are less correlated and therefore less affected by the ups and downs of the stock market, there are still a majority of alternative investment classes that are being negatively impacted by inflation. However, there is one alternative asset that actually performs better during inflation, and that's contemporary art. Investments in contemporary art were only accessible to the top 1%, the billionaires that could afford to buy blue chip art for millions in hopes of a high return later on, until Masterworks, a sponsor of the video, came along. Masterwork is an investment platform that democratizes the art market and making it possible for anyone to own a piece of a multi-million-dollar artwork by artists like Picasso, Banksy, and Basquiat. The way it works is simple. The art they purchase is filed with the SEC as a public offering, making it possible for you to buy and sell shares in it. Being that art is one of the highest performing alternative assets, it's no surprise that contemporary art prices have been outperforming the S&P 500 total return by 164% for the past 26 years. Masterworks is giving everyday people like myself and you guys a way to participate in the art market like a billionaire art collector, so we can diversify our investments in case of a crash or if we just want to make some more stable returns. Signing up is super easy, takes less than 60 seconds. If you want to skip the waitlist, click the link in my bio and check it out. Next way to protect yourself is through option trading. There are actually two ways I would do this. The first way is through buying put options, and the second way is by selling call credit spreads. Starting with a put option, buying a put option is betting that a stock will fall. Instead of doing something very risky like shorting the stock, a put option lets you do that with much less risk. You can only lose what you pay for the put option, and oftentimes they're not expensive. Each option controls 100 shares, so you can make a lot of money buying a put option on a stock, and if and when it falls, you can see a big return like 100% or 200% on the option. That's because a put option is going to increase in value a lot when the underlying stock you buy the put option on falls. This is perfect to protect your portfolio because as the market or the stock you buy a put option on falls, you make money hedging against the risk of the market. You can also buy puts on stocks you think are overvalued for 1 month or even 6 months. Put options have many expiration dates, and buying some in your portfolio is like insurance. I personally wouldn't say buying insurance is profitable and the insurance companies make money in the long term, but likely we have all had or know someone that had an emergency when insurance did help them. That's the point of insurance. If something happens, you are protected. In fact, a put option was initially intended to directly protect and guarantee you get a price for your shares. For example, say you have Apple at $160. If you buy a $150 put option, it will guarantee that you get $150 per share no matter what. So if Apple were to crash by 50% down to $80 per share, as long as you had your put option open, you would be able to get exactly $150 per share for it. Next way you can hedge yourself and protect is through call credit spreads. Let me show you an example. All right, guys, so let's take a look at a call credit spread. In fact, I have a couple of these open. One of them that I have open is this one right here, this Nets call credit spread, and this Rivian call credit spread. You can see here that I made $200, and then on this Rivian call credit spread, I made $305. And essentially, I'll open up net. I'll show you what this position looks like. I'm up about 88% on this option currently. Right now, if you take a look, I am selling a $135 call option, then I am buying a $140 call option. Basically, the $135 call option is worth a lot more more than the 140, so I'm collecting the difference in the spread. And in fact, when I sold this spread, I made an average credit of about $45 per spread. I opened up about 5 of these. So I collected a total of $225. That's what you will see right here, a total credit of $225, and currently the market value is only $25. So if I were to close this position, I'd be up $200. Now, let me explain the mechanics of how to open up a call credit spread, why you would want to do this, and the cost of doing so, okay? And I'm going to open up a new call credit spread. The market is closed right now, but I'm just going to walk you through this example. So taking a look at the technical chart right here, I mean, basically this stock is down a lot, and I don't really see it going up too much because Cloudflare has a good business, but one thing that I look for is a price to sales ratio. The price to sales ratio, based on my analysis, is pretty high. It's more expensive than the market. It's way above average. And although this company is a cloud-based service that does a lot of stuff within reliability, video streaming, delivery, advanced security insights, all of these good things, that's fine. But when a stock is expensive, it doesn't really matter how good the business is, because typically it's not going to perform that well, and especially not that well in the short term, because there's no real reason for it to do that if it's already very expensive. Now, in terms of the price to earnings ratio, you won't even see this because it's negative, since this company is still losing money. So anyways, I have determined that the stock is expensive, and it has a lot of resistance points around the $100 level. I mean, you can see right here, this stock tried to get to $100, but it couldn't do so. It stopped at $98.86 in late April. Now, this stock was over $120 in mid-April. But anyways, for the short term, let's say for 1 week out, I don't expect this stock to go back above about $100 per share. So what I'm going to do is I'm going to click trade net options. I'm using Robinhood. If you want a free stock, or a couple free stocks actually, they usually hook you up pretty well with my link in the description. They've given people Apple and Nvidia stock, so go ahead and check that out in my description when you sign up. Now, selling net call credit spreads, the first thing you want to do is you want to click sell call option. Now, I'm not going to go for May 6th since that is tomorrow as I'm making this video. I'm going to go to May 13th. That is about 1 week away. If I scroll up and I look at the $100 call option right here and I expand this, it's looking pretty good. I mean, the bid is $315, the ask is $345, not as tight as I usually like it, as I teach my students to basically have a bid ask spread difference of 5 or 10 to be more ideal. But you know, this will have to do, it's about 0.3. But if you look at the implied volatility, it's very, very, very high. I mean, 122 is pretty much unheard of. In fact, anything over 100, I try to stay away from, but I do follow net pretty well. I'm not recommending this trade right now because what I think is going on, the reason why this is so high is they probably have earnings, but you still want to use this strategy on different stocks that you think are expensive, or even net after they report earnings. So anyways, the volume is pretty healthy as well, 136, and the delta is 0.32, so a nice out of the money option. What I'm going to do right here, I'm going to click this premium right here of $330. Now, if I were just to sell this right now, this wouldn't be possible because this would be a naked call. I'd be selling a naked call, exposing me to unlimited risk, and I do not recommend this type of trade for anyone. However, this is not a call credit spread. A call credit spread is when you buy a call to protect the sell call that you made, okay? So we sold a call at 100. Now what we're going to do is we're going to buy the 105. You could also buy the 104. In fact, if you have a tiny portfolio, you can buy the 101 call option right here, and basically you will collect the difference from 330 to 301, which is $29 on $100, which is basically not even $100. Since you're collecting $29, it's only really $71. So you can start option trading with $71 and you can collect $29. But this would be kind of high risk in this example, and also because net does have earnings. However, still, I'm not going to deny that selling call credit spreads can easily make 10% a month. Now, in this example right here, if I were to sell the 101, that would be almost a 50% return. Now, let's go up to 105 because I like to make my spreads around $500. It's nice and easy. Even if you have a small portfolio of $5,000, you can still make 10 trades of $500 each. Or if you have $2,000, you can make 4 trades of $500 each. So I do prefer this, and I do like to work with students that at least have a few $1,000s to invest because it makes it a lot easier to grow their portfolios. It is unfortunately easier to grow large money than it is to grow small money. Not to say you can't grow a small portfolio, it's just easier the bigger that you get. Now, let's go ahead and buy the 105 call option and show you exactly how much money you're gonna make. So you'll notice right here, the total credit is $122, okay? Now your max risk or your max loss is only $378. This is basically 1/3 or about a 33% return. Really high, and not only is this a high return, it's also a hedge in your portfolio because this position isn't going to lose you money unless net goes up, and usually if net goes up, that probably means the whole market is going up. So you're creating a hedge in your portfolio because if the market is going down, then most likely net is also going to go down and you're going to make money on this position. That's how a call credit spread really functions in your portfolio. It's meant to be done on stocks that are expensive aggressive using my core cardinal rules I teach in my private Discord, and it's meant to create income at the same time as hedge your portfolio. For more videos on option trading, make sure to check out my option playlist. Also, make sure to check out the description link for Masterworks if you're interested in investing in contemporary art.